Good afternoon. Thank you for joining us for Kolibri Energy's operational update. Kolibri trades under the ticker symbol KEI on the Toronto Stock Exchange and KGEIF on the OTCQX. With us today from the company are CEO Wolf Regener and Gary Johnson, CFO. Kolibri has had a very exciting year utilizing their new drilling technique in the Caney Shale in Oklahoma, yielding tremendous results. On Monday, they announced a 10-day rate on their Emery well of over 700 BOEs per day, with more news to come in the next few weeks on the last two wells of this year's drilling program. If you have any questions, please enter them in the Q&A box, and as always, the presentation may contain forward-looking statements. Welcome, Wolf and Gary. For those that were unable to view the last webinar, perhaps we could spend just a few minutes on discussing the background of Kolibri and the management team, and if there's anything you want to discuss from Q3, and then jump right into the operational update.
All right, sounds good. Thanks for the introduction. I'll keep it quick on the overview. Short version is, I think we are a good, solid company, have a great asset that we're proving up and convincing people of, I think, more and more that they're starting to believe us that we have a great asset with every well that we drill. We have a good balance sheet, cash flow that's growing rapidly, and hope to show you why we're undervalued compared to our peers. And as Jessica said, we'll take a look and go over our latest results a little bit further. Forward-looking information on these slides here, disclaimers as well, and then obviously some 2 pages of non-GAAP measures, which are comparable to what the industry does in general. Management, myself, 36 years of oil and gas experience. Gary, 30 years of accounting experience, over 20 in the oil and gas business, including Occidental Petroleum, Director of Technical Accounting. Both Greg Presley and Alan Hemme, who have been with us for quite a long time, our senior engineer and senior geologist, helped us refine the play and make better and better wells as we've been learning how to exploit the Caney in the best possible fashion. Board of directors, we just have a well-rounded board, I think. David Neuhauser is our chairman, years of experience in capital markets and M&A. Eric Brown, head of our audit committee, the CA, and Leslie O'Connor, reservoir engineering, ex-Sproul and MHA Petroleum Associates, so was running their Denver office for years. And Evan Templeton, our newest board member, adds a lot with his background in high yield leverage loan markets, great in stress testing, things like that. He's been a great addition to our board and lots of experience on the US side of things and nice contacts in the US as well. With that, we'll skip through these slides, but just point out that the biggest thing that we have is, what differentiates us as much is, at the end of last year, our PDPs were only 10% of our proved reserve total. So we have a large number of proved undeveloped locations that we're drilling this year, and I think showing everyone that these really are low-risk locations that we can keep exploiting. Where we're located, we're outside of the town of Ardmore, halfway between Oklahoma City and Dallas, roughly, in Oklahoma. You'll see around us, ExxonMobil has about 280,000 acres leased all around us. We were the last holdout when we originally developed the Woodford Shale, that's slightly below the Caney, which we're developing now. Woodford was about 80% natural gas, the rest NGLs and oil. Now we've kind of switched things around, a complete flip actually, where the Caney, even though it's only 350 feet above the Woodford, is producing about 80% oil in the area we're focusing on, with the balance being natural gas liquids and natural gas. Our production, 74% is oil. I had mentioned the 80% because we're focusing on the area of the field that's a little less gassy. We have one small section of the field that's a little gassier. It's what brings our production numbers down a little bit on the oil side of things. And then the gas and NGLs fluctuate a little bit. Right now, it's about 11% gas and 16% NGLs. Out here, we sell all of our oil by trucking it out. We have WTI pricing less $1.85, so not a big differential at all. And then the gas and NGLs, Exxon takes care of those for us. They market it actually for us along with their own stuff, and We just pay them a transportation or a gathering fee and a compression fee. Adjusted funds flow or adjusted EBITDA for those in the US, they're basically the same. Last year was about 6.6 million US dollars, by the way, and everything here. And our adjusted funds flow for this year is estimated between 23 and 25 million. So obviously a big increase, all due to the wells we're drilling and what we're hoping to bring these last ones on for as well. Production, 1,700 BOE a day at the end of third quarter. Our target exit rate was 2,700 BOE a day, and has been like that since the first quarter when we announced our forecast here for the year. Proved reserves. So Netherland, Sewell does our reserve engineering, $360 million in US for our proved reserves at the end of last year. So prior to our drilling any of our wells this year, that had done quite well actually and outperformed the expectations, was $360 million. Our US market cap today is probably around 100 million roughly. This was a $3.44 Canadian stock price. And so you can see that there's quite a bit of disconnect between what our proved reserves are and what our US market cap is. Going into a little bit more of the metrics, as I mentioned, using a $3.44 Canadian share price, we have a little over 35 million shares outstanding. Market cap, a little bit higher than 344 this morning. We have a little bump, call it 100 million. We had 11 million net debt. So that's 16 million to the bank, but we had about 5 million in cash in that third quarter. And so that gave us a US enterprise value of around 87 million. So forecast, as I mentioned, year-end exit rate, we had targeted 2,700 BOE a day. Adjusted funds flow, 23 to 25 million. Debt to EBITDA less than 1 because we hadn't really increased our debt and we're trying not to. We're leaving the debt forecast in the 15 to 17 million range. Mentioned that we had been, the wells we've drilled this year have been outperforming. So the green line here is the PUD curve put together by Netherland, Sewell. So they've taken our wells on the east side and just took an average of everything. So a couple of wells had a shorter length lateral in them. They didn't normalize those. What we've done is we've taken what we consider the corridor of our property. The shorter length laterals, we've made them a full length lateral to a 1 mile lateral. And that's the average of those wells here. So nothing big on our end, not taking any big risks going forward. So our first wells that we drilled this year that came on early this year, the Barnes 7-3 had an IP of about 940 BOE a day. The 8-4 had an IP just over 600 BOE a day. Again, our type curve BOE was around 480 BOE a day. And the PUD case by Netherland, Sewell was just under 400 BOE a day. As you can tell, we outperformed those drastically. Really good IRRs. And just to put it in perspective, 2.4 to 1.5 times higher than the Netherland Sewell PUD case is what these wells did. So what we were saying for the rest of the year is all of our forecasts use this blue type curve. And we were hoping to exceed that. And so one of the other wells that I put in here is the Glen 16-2. This was its IP of about 640, I believe, BOE a day. And that was our first well that we did with a new generation of fracture stimulation technique. We used a high-visc friction reducer in order to keep the fracture stimulations from going out too far, keeping the stimulated rock volume in close to the well bore so we can get more oil out. Before I get on to anything else here, talking about the estimated ultimate recovery, these are numbers from Netherland, Sewell for our PUD case. You can see year by year, they've been increasing. And so it's showing you that the reservoir is of good quality and has been performing well. So every year they started increasing what they thought the offsetting wells or proved undeveloped locations would do. The Glen well, which was at 640 BOE a day well that I mentioned on an IP, according to Netherland Sewell, will end up producing about 765,000 BOEs on an EUR, obviously substantially higher than the 550,000 BOEs in the PUD case. So we drilled our first two wells earlier this year, the Barnes 7-3 and the 8-4, through our third generation fracture stimulation, by the way. And the well that we just announced on Monday was the Emery 17-3, IP10, so 10 days worth of production, not the 30, was over 700 BOE a day. Historically, some of these wells have been doing, between their initial announcement, which was anywhere from 3 to 10, 12 days, have been holding in there pretty well to those numbers. So we're expecting the Emery hopefully to stay in this range here of the 600 plus BOE a day. That's what it's looking like, but we won't know for sure until we get the 30-day average. The Barnes 7-3 had a little higher initial IP of 1,050, ended up being around 940. So it did come down a little bit. But the bottom line is, this is our third well of the year that has done quite well. We have two more wells that we've already drilled, fracture stimulated, the Brock 9-3 and the Glen 16-3H. And those wells, we were drilling out the plugs from after the fracture stimulation, and we're expecting to bring those on and start flowing that here later on this week. And in 2 or 3 weeks, hopefully we'll be able to announce rates from those wells as well. So far, everything's gone really well on it. And so we have high hopes for that one as well. Just overall, you can see here, the green are all the Netherlands Sewell locations in the corridor here. You can see that 60 approved locations for the property is what they give us credit for. And you can tell that most of these are all in the corridor. What we consider the average, meeting our type curve. And now that we've been outperforming that type curve, I think also in the future, we'll be able to get some of these wells out here into the proved category, but we'll wait and see. But that does give us 60 some other locations for proved that we believe that we'll have in the future. 17,000 acres, 185 total locations out here, and including your probables and your possibles out here. These are obviously a little higher risk. That's why they're possibles out in this region. We do have some ideas to make that work in the future. All the gathering systems are in place. So our well cost, we'd estimated at about 6.9 million. That includes the facilities for each well. And so wells online from start to finish in that range of 6.9 million. I mentioned that Exxon handles all of our gas and NGLs. Gathering system is always within a half mile to a mile. So we don't have any big costs out here for that. All of our acreage is actually held by production, or almost all of it, 99%, because of those deeper Woodford wells that I mentioned in the first place. So those are all holding all these leases all the way out here, even where we don't have any reserves booked yet. And we hope to in the future to expand that. Adelaide only evaluated that portion of it.
Okay, so that is not in your reserve report at all because you haven't drilled anything out there. Yeah,
exactly. And right now, all of our reserves are booked in the Caney. So it doesn't give any credit for any T-zone wells where we tested 4 wells originally. So there's no PUD locations in the T-zone, but we do feel that the T-zone exists over most of the property. And we had tested it in 4 wells. It's a little gassier, but with gas prices where they are, that those should be quite economic as well. We also have the false Caney above us, which we have not tested, just looks good on logs. And we think that covers about 8,000 acres of our 17,000 acres out here. Those are future potential that we have as well. Talking about comparison, why we think we're undervalued, looking at a number of our Canadian peers, just looking at the enterprise value versus NAV at the end of last year from our NAV. So it doesn't take into account any of the wells we've drilled or anything else, nor anybody else for that matter. But you can see we're trading at about 20% versus the average is about 88%. So quite undervalued. And this is at a $3.44 Canadian stock price. So even at 350, 360 where we are this morning, we still have a long ways to go to catch up to where our peers are on a proved basis. Proved probable, same thing. We're at 14%. The average is 59%. We have a long ways to go to catch up to our peers. It's a $13 per share Canadian if we're looking at 100% of our proved reserves on a per share basis. On a proved and probable reserves, it's up in the $18 range. And again, $3.44 is where we're trading now. So we really took a look and said, why is it here? First thing we looked at is operating netbacks. And these are in converted to US dollars for the Canadian companies. We just used an exchange rate to convert those. But we had the best operating netbacks compared to these other companies that we were looking at. So that's not it. Our G&A has been coming down year after year. So we've cut costs, as most companies have that have been around still, obviously. OPEX per barrel of oil equivalent, we're also on the low end of the peers that we were looking at. And really, these lower three are actually natural gas producers that have lower lifting costs. So these are more oil producers, and we're on the low end of that. For our US people that aren't used to seeing royalties included in our OPEX, without royalties, we were at $7.77 on an OPEX number. So we said, okay, what do? We need to increase our capital spending to drill wells and hopefully execute well. And so that's what's been happening this year. So our first three have obviously gone quite well, and hopefully the last two will as well. Looking to not increase our debt, keeping the debt in 15 to 17 million. We do have a Bank of Oklahoma line of credit. That's 25 million. So we have a capacity available for us, which helps when you have to prepay things like that, especially when things like casing are in tight supply. So we've been pre-buying things like that and making commitments in advance to make sure we can execute. We think as we keep drilling wells and executing, people will start noticing us more and getting up to value. To show you cash flow generation capability for us, this is just an illustrative development. We took an arbitrary number and said, look, if we get production up to 3,000 BOE a day, and keep in mind, we did this in late first quarter, early second quarter, I can't remember exactly when. Oil was trading at about 110, 120 a barrel. So we assumed an oil price of $90 a barrel. So obviously a little higher than we are now, but not too much. And we said, what does it take to get to 3,000 BOE a day and hold it there? So we said, okay, the 5 wells we're drilling this year, 6 wells in 2023, 1 well in 2024, 3 wells in 2025. So once we get there, you can tell it's about 2 wells a year to just hold production there. One thing I'd like to point out is that this is using our type curve, that blue curve that I spoke about earlier. So not the higher rates that we're getting off of these wells. And hypothetically, we said, okay, we'll take all that money, we'll pay down our debt to 0. Now, do we do that or not? That's left to be seen. That's our recommendation, and then obviously a board decision. But for this hypothetical example, we said, look, we could pay down our debt completely. We could still drill these wells every year, and it only takes 2 or so on average. And what would that be generating? So at a $90 oil price, we'd be generating over 35 million US per year in free cash flow, CapEx taken care of. So in that range, that's over $1 share US that we could generate in free cash flow. Now, what would we do with that? Realistically, we'll probably drill more than 1 well in 2024, but we could do dividends, we could do stock buybacks, or we could obviously increase and drill more wells, or we could use some of that cash flow for some other ideas we have in order to pick up other projects that we have our eye on. Anything that's accretive to the company, which is important to us. And people say, how much running room do you have? Well, we have 60 proved locations currently. We've drilled 5 of them this year. Maybe not all of them are there, but we have a lot of running room, even if you're on a conservative basis, if you're drilling 2 wells a year in order to keep that cash flow going. That's kind of the short version of the flow through, of go through of what we've been doing and what we're looking to do. So next year's guidance we haven't put out yet. We're waiting for the results from these wells. We'll present that to the board and have a board discussion and then approval of our guidance for next year. But that probably won't happen till January or so, because we're just bringing these wells on now. And between oil and gas prices up and down and not knowing exactly how these wells perform and us wanting to use cash flow to drill wells going forward, that leads us to not putting guidance out until early next year.
Okay. Thank you for that run through. I just got to see what the question is from the audience here. Okay. Do Do you think you might look to drill more in 2023? I also have a similar question. Just given the results that you've had with this year's drilling program, does it change how you would attack your drilling program for next year? Then maybe you were looking at it differently at the beginning of 2022. Has it changed your development plans at all?
Yeah, I mean, us performing, hopefully these last two wells come in similar to the other wells we've drilled this year, which would be great. We were going into this trying to be conservative and not knowing exactly where it's going to be. It made sense to us that we could at least do the average of what we've done in the past, even though those are done with a previous generation of fracture stimulation techniques. We should be hopefully drilling more wells, assuming oil prices hold up as well, than we did this year. But again, I'd like to see these numbers so that Gary and I can put a forecast together and a recommendation to the board for them to approve our capital program. But hopefully it'll be more wells than we drilled this year. Should be.
Okay. On the wells that you have longer rates on, what were you seeing as far as declines on a 30 to 60 and 90-day basis? And how do they compare to the wells that were drilled historically with your old fracking technique?
Well, here, this curve kind of shows where it is. And like I said, our average type curve should be at least this here as far as declines go. We historically had about a 50% decline in the first year. I don't have it broken out between 3, 6, 9 months. But, it flattens out fairly quickly when you get out here in production. The Glen well that I mentioned, we've got almost 4 years of production out of it, which was our first generation completion of the new completion technique, I should say. And really what that was is we went to a high viscosity friction reducer rather than doing a slick water, switching to a linear gel, switching to a cross-link gel. So that should stimulate more rock volume closer into the well bore and give us better and better wells. And so far, that's what's it's showing. And we've just improved on that since the Glen well.
And you said you've been seeing minimal communication between the wells as you're fracking them.
Correct. Yeah. And some of the older wells, we've seen some communication because that technique that we originally used will generate longer fractures that go out further. So that's not surprising. But all the wells we've drilled with the newer fracture stimulation technique, we've seen much less interference, just a slight pressure increase, no brackets or anything else.
Perfect. So you said your Q3 production 1,700. So with the new Emery well, we're about 2,400 BOEs a day. I
mean, you have some decline. You have some declines going on in the existing stuff, right? Still, so
yeah, sure.
That's in the ballpark.
Yeah. Okay. And I know that's flush. So your flush rate by year end could be significantly higher, I would think, with the other
Fingers
two.
Crossed.
Yeah.
Fingers crossed on these next few wells. Yeah. Everything looks good so far. So,
well, yeah. And you did say the Glen 16, the 3H had the best oil and gas shows thus far.
Yeah, they had the strongest gas shows from the wells that we drilled. So they're all within a band, but it was on the higher end of the band. Emery actually was on the lower end of the band, but obviously it did really well. Yeah, not always a direct indicator. So
no, that's true.
Everything
looks
good.
There's just when you think it should be, it isn't.
Exactly.
I did have one question. Now, I've had some commentary from some people on the Caney Shale specifically, saying it can be they're citing variability and it's not a true shale play. Now you've spent a lot of money and time developing the Caney, so I think you have somewhat disproved that, and maybe you can speak to a little bit to that as far as your step outs, etc., and where you've seen variability and why you think your sweet spot is just that, a sweet spot, and extends pretty far as far as your land package goes.
Yeah, happy to. So we've had to learn a lot about the Caney, and starting with how to drill it and where to put the laterals. That's what some of the early wells were. And then how best to fracture stimulate it. Every shale is different, and the Caney is no exception to that. The Caney actually looks very similar from logs point of view across our acreage. But in some areas of the field, It's a little shallower, so it has a little less energy. We're a little less in the gassy window. And so that's what causes a little less energy from our point of view, what we've learned so far. So in order to get the far east side productive that we haven't tested out there, we need a little different fracture stimulation technique to make it economic. I think it would produce, but just not at the rates that we're producing here. We've also tested the Caney originally in a different part of Oklahoma, and it didn't work very well. So shales do change in different areas, and ours were actually quite unique. The Caney is the same or similar to the Merrimack, but the Merrimack that other people were going after in different areas of Oklahoma is a different facies. So we are truly a shale. We don't have very many or hardly any high perm streaks, so we don't target anything like that. We're just drilling in what we consider sweet spots within the shale that are just a little bit cleaner. And that's why I think we have lower decline rates. Over time, our gas oil ratios don't change much after the first 3 to 6 months, just because we think that the Caney generates the actual oil and gas. And so we haven't had migration in, other than in some areas of the field where, like I mentioned, we were a little gassier, where we had some Woodford gas that had migrated up. But in the corridor, it all looks very similar in the right depth band, and sticking in that depth band where that higher energy is. We're hoping that we can keep making wells that are well above our corridor type curve.
So, like you said, you don't see a big jump in GOR in most of your wells. It's pretty consistent throughout its production cycle.
Yeah. After the early stages, but yes.
Yeah. Okay.
Yeah.
Okay. Now, given you have 185 locations, 60 are proven, how do you see that changing without, I know you can't commit to a number, but without having your new reserve report? How many do you, well, I'm trying to ask this so I don't get you in trouble, but how do you see that changing? And that obviously changes your PUD ratio.
Yeah, a couple things on the reserve report overall. On the slide, the 550,000 BOEs that Netherlands Sewell gave us credit for at the end of last year. Glenn, them projecting at 765,000 BOEs, and then with the IPs that we've had this year from these wells, and hopefully the next two wells are above our corridor type curve. I think that they'll start having to move this EUR number up. So if you move that EUR number up on a per PUD basis, then that'll change our proved reserves overall. How much that goes up is what we don't know at this point. So that's the first thing that'll change our reserve report. The second one really will be, as you mentioned, location-wise. I don't see it changing too much. I just went the wrong way. Because we're drilling locations that have been identified by Netherlands Sewell. Right, so we're not drilling any probable locations out here yet. Eventually, I'd want to drill some wells out in this region here that are probables and possibles, and we believe that this will also look good and perform well. These were the gassier wells that I mentioned that we drilled a few of. So we should be able to add some proved locations. How many, again, will be determined, but this year the biggest increase will be on the proved reserve number, just from making better and better wells and having each well perform better, or the expected performance of that should be better going forward. But it will be up to the third-party independent reserve engineers to determine how much that goes up. I know where I'd move it to, but that doesn't mean that they'll move it to there.
No, there's always a lot of fighting that has to go on.
Exactly.
Now, for, again, next year's program, I'm asking a lot of stuff that you can't get, you won't be able to divulge quite yet, but will you mainly be focused on a lot of downspacing, or just still kind of drilling out the sweet spot and then maybe 1 or 2 step outs?
Yeah, I mean, our plan right now that we'll, again, present to our board for approval as well is to drill some of these other locations that Netherlands Sewell has identified. It'll be a little tighter spacing than it has, but as you can tell here, we've had some wells that have been tight spacing already. That isn't any really it's about where we would be on a 6 wells per section basis. And, those wells have worked well in this region. So we expect with our new completion technique, that's not what we used on those other wells in the past, that, there should be minimal risk for, downspacing and proving up these locations. And, we'll evaluate whether we can go to 8 wells per section actually at some point in time as well.
Okay.
But we'll really be focused on the corridor, and then maybe we'll put something down out here as well. But for now, it'll basically be the corridor.
And you probably won't answer this question at all, but in your mind, using a $60 to $100 WTI range, can you give an indication of how many wells you may drill using $10 increments on WTI?
No, because I don't know where these wells are going to end up yet, the last 2. So,
Okay.
you got variability.
I didn't think you'd answer that, but whatever. I thought I'd ask.
Not only a $40 oil price change, but
I was trying to come up
productivity.
with something.
Yeah, I know, I understand. But like I said, it'll be a lot easier once we get these wells on production and get them going, and then see where we think cash flow is and where we expect pricing to be. Then we can run some models on pricing only.
Okay. And, one other criticism I've had is that you have a small area of land, which is really actually not that small, 17,000 acres, but maybe you want to remind us what Exxon paid for, your 12,000 acres of Woodford.
Yeah, that was $147 million.
Yeah. So
that was mostly a gas property or the gas field.
Exactly, not oil. Yeah. So we can dispel that criticism as well. Now here's given you have 185 locations and your PDP could easily be 200 million by the end of the year. So basically the same question I just asked that you wouldn't answer. So we'll just ignore that one. Okay, sorry. I guess we'll know a lot more in January. We'll have it.
Yeah, that's really what it is. It's a hurry up and wait. Like exactly. It normally happens in the oil and gas business, unfortunately.
Yeah. Okay. And then, so these two questions kind of tie into each other. Now, your bank does make you hedge. I do know that. Do you think they will lend at least 40% of your PDP NAV at year end?
I don't know. I just, the last few years, lending has been really different than it has been through most of my career. Banks have really pulled back on percentages that used to be able to rely on a lot have changed a lot. I would hope we could we could be in the 40% range for ultimate availability from the PDP numbers, assuming oil prices are matching what those PDP forecasts are as well. And that's the bank's decline curve, or the bank's decline curves and the bank's forward pricing looking. So it's possible, but again, that's out of our control to a large degree. Just depends on where lending is. Lending gets sometimes tighter, sometimes it's looser, but I don't think it's unreasonable to be in that range.
Okay. And again, if you want to remind us how much they make you hedge and what are your hedging plans for the future?
So we have a rolling 2-year hedging program that they want us to do. It's 75% of what the PDP is based on their last look at our reserves. So we'd have 0 on these wells that we were bringing on till they look at it again. We do want to discuss with them if we have, 16 million outstanding and we bring on 3 more wells that are good. I don't think we need to hedge 75% of our forward production. It should be commensurate with how much we have outstanding on debt. So that'll be a discussion that we have after our year-end reserve report is done and when we do our year-end reserve redetermination with them.
Would you look at doing any term debt, or are you going to stick with bank financing?
You know what? We'll consider anything at any point in time. It just has to make sense, right? So we try to minimize the cost of whatever we do, whatever works and makes the most sense for the company. So Bank of Oklahoma has been really good to us we've had a good relationship with them, and they've been very competitive. If we have a great deal that comes along on a senior debt piece, sure, why wouldn't you look at it?
Well, yeah, if you don't have, I mean, you usually have a little bit more flexibility with term, but
Right.
who knows? Who knows? The banks might get easier to deal with, but it doesn't look that way.
It's been up and down a lot over the last 2 years, right? Mainly down.
Oh, yeah.
They opened up a little bit more, but like I said, it's we've had a good relationship with Bank of Oklahoma. So if something comes along, obviously we take a look at it. We always do. Like we always say, everything that we have is for sale as well for the right price.
Mm-hmm.
Right? So,
speaking of things for sale on the acquisition front, what do you are you getting any closer on looking at acquisitions, or do you need the stock price to go up significantly more? Or have you been?
I think we're so undervalued. So if we were to use equity to acquire something else, it would have to be a very special property because we are so undervalued compared to our peers. Once we get up to higher numbers with our more comparable to where our peers are trading, it would be easier to do something. We have our eye on a couple of things, but it's just not there right now.
Are they willing sellers?
We'll have to find out. I haven't told anyone what we're looking at other than our internal team. So we haven't.
You don't say a lot, actually, Wolf. Really.
That's called survival and trying to grab something that someone else. No need to give tips to anybody else.
I'm going to have to start talking to Gary more. Maybe he'll tell me. One question here: where do you truck your oil, and how's it sold?
It's all trucked out. It's generally what we do is we go to bid on it, and there's a number of loading racks that are pretty close to us, and so we generally have 3 or 4 bids that come in that are all within a nickel to a dime of each other on trucking. So that's how it works. Yeah.
Okay. And where do you think your stock should be trading at, given the value discrepancy against your peers?
Obviously higher.
Yes, we'd all like it to be higher as owners.
But if we look at some of those slides that we had put together, I think we should be trading up near where our peers are trading. Even if you're getting down on the lower end, we would need a double on improved for basis just to not even get us close to that. It would be over a double to get us into the lower end of the comps. And 4 times higher to get us into the average of where everyone is. And I think with the netbacks we have, with the IRRs that we're generating on these wells, I don't think that it's unreasonable for us to be trading where our peers are trading on an average basis, because we've got a great property that's doing well.
Well, I think one of the issues is because you did do the spin-off, and then you stopped doing much, so you kind of got swept under the radar and kind of stayed there. And again, I should remind everyone on who's listening today, there's been no analyst coverage yet, which we're working on, which is unbelievable given the value proposition. So, there's one way we can help get the valuation up, but it's crazy. But I think it's just been something that's been overlooked, and because of the change.
Yeah, and we hadn't drilled a well in 3 years, right? So there wasn't a whole lot to talk about. We, in the downturns, you don't spend money on IR, you don't spend money going to conferences, and you just buckle down and survive it. And for the company the size that we were, we made it through it where a lot of companies didn't. But that's what you have to do in this business.
Well, right? You did the prudent thing, right? Yeah. Why waste your resource when you're giving it away? So,
and our acreage was held by production, so we had the luxury of not having to drill.
Yeah.
So,
yeah. 2 other questions I had before we finish up. Testing the other prospective zones. Do you see you doing that next year, or is that further down the line?
Don't have any firm plans on that. We can take a look at that maybe later on in the second half of next year. But like the T zone is known to us because we've already drilled a few wells into it. So that'll be more along the lines of, let's run some economics. Let's see where natural gas prices are, how that works, and then go at what our average one was in the first place, and then couple assumptions of how our new fracture stimulation technique can improve that as well. So we'll kind of risk that as well. But first half of the year, probably not. Second half of the year, we'll take a good hard look at it.
Okay. What do you think? I know this is a hard one to answer as well when you're just bringing on new wells, but what do you think your corporate decline rate is?
Yeah, that's it's going to be higher than it was just because we were bringing on these brand new
bringing
wells.
on the new wells,
So,
but let's let's not count the new wells you're bringing on right now. So
previous, we were, I don't have that off the top of my head. Maybe 15% a year, probably less.
Okay.
But that's probably in that number somewhere. Don't hold me to that one, but it's in that ballpark, I think.
Okay.
So, and the longer these go on, the lower the declines get. So the older wells aren't declining much of anything, right? So they're a couple of percent, and the newer ones were still coming down a little harder.
Yeah. I mean, I was kind of, thinking around once they settle out a little bit, would 35% be a fair number?
Yeah, I mean, it depends on next year how many wells we drill too, right? The more we drill, the more you're looking at
then the higher the
decline on those in the first year, right?
Yeah.
So it's a hard number to pin down with assumptions, but 30% is probably reasonable from here, depending on the well that we have drilled, right? But the new ones are obviously will probably be 50% in the first year, and
for sure.
Look at that, we were doing 15, 16, 1700 BOE a day prior to these. Then and you're bringing on wells. If we are fortunate enough to have wells that we've got the 700 BOE a day well, and fortunate enough to have a couple more at 500 BOE a day each. That's 1700. So you're doubling your production with 3 wells suddenly.
Yeah.
If we can get in that ballpark. So, but we'll see.
I think historically, this basin has declined less than other basins, right? What did we study that with? Like the Permian, we declined less than like the Permian Basin did, for example.
Right.
In the first year.
Yeah.
That's a good thing to remind people of.
And then one of the other advantages that didn't get into here is, we don't produce much water here. That's why our lifting costs are fairly low. So when we were producing, let's say 1,400 BOE a day, our water production, was around 100 barrels a day for the field. So not counting the new wells that are coming on, obviously, because we do get frac fluid back from those. But our legacy wells don't produce a whole lot of water. So we don't have a lot of disposal costs. We don't have to drill disposal wells. We can just truck the water out and have someone else deal with it. So that keeps our costs down as well.
That certainly does keep water can be a good thing as a drive, or it can be, but it can be a very expensive proposition as well. Right.
And in a pure shale, you don't really need it. You don't want it as a drive.
You don't know. You want them, so it ruins the reservoir. Yeah. And then just what do you think is your biggest risk at this juncture?
I don't know. Probably, down spacing if we go to 8 wells per section and they don't perform quite as well.
Okay.
If they decline harder than we expect, that's an unknown. I expect 6 wells per section to be just fine, but if we decide to test an 8, that adds a little bit of risk.
Well, that's pretty good if that's the only risk you see at this point.
Yeah. So everything so far, we've been able to get equipment okay. Hopefully prices stay where they are here on oil and services. That we've had our big price increase and that's it.
My understanding is service-wise, things have pretty much stabilized or up a little bit more, and then still, and I don't know what you're seeing on pipe, but how are you said you pre-bought?
Yeah, we pre-bought for first quarter already, so we're okay there. But it looks like it. I'm hoping that has stabilized, and hopefully it'll start coming down at some point.
Yeah, we just have to get people back to work in China. Okay. Well, I don't think there's no other questions from the audience, and if you guys have nothing else, we can probably end it there.
Sounds good.
And we're looking forward to seeing the results of your 2 other wells here very shortly.
Yeah, as are we.
And if anyone needs any further information, please feel free to contact me at jessica@adcap.ca, and I can certainly assist you. Thank you for your time, gentlemen, and have a good afternoon.
All right. Thanks for everyone for watching and joining.